Hello friends, today we are going to talk about export and import management, and the unit is 1 where we are going to talk about understanding and basic concept of exports and import. Now before we start, we need to understand what is international business. Now international business refers to the trade of goods, services, technology, capital and knowledge across national borders and at a global or transnational scale. International business involves cross-border transaction of goods and services between two or more countries. Transactions of economic resources include capital, skills, and people for the purpose of international production of physical goods and services such as finance, banking, insurance, and construction. International business also today known as globalization. Now, what is export? Export indicates supplying goods or items from own country to other countries, and imports deal with the buying or getting in goods or products from different countries to one own country. As there is a rapid development in the global market, new trends in trading have been launched. Trading in different countries is quite easy and convenient because of the today's smart as well as intelligent technology. The import and export market has gone through vast alteration over the years. I still remember in 1990 when the market has been open in our country, the new reforms have started. At that point of time, export and import doing for any company was quite tedious job because there was a lots of procedures, documentation. But today, after 30 years, things have changed, and whether you are going for an export or import business, it is very easy. Yes, you need to understand the procedures and the documentation, no doubt about that, but it is very simplified. So, what is the basic of exports? If you are planning to export, you need to understand the challenges of exporting and have sound knowledge of your potential markets. You also need to consider whether your product are right for each target market or not, or whether you have the necessary resources to start exporting and transport considerations. Before you commit to exporting, you need to honestly assess your export potential, both in terms of readiness of your business and of course your product and services. It is essential to carry out detailed market research to identify and evaluate the target market. You also need to examine the industry structure. You also need to understand the demand of your product and services in that particular market where you are trying to export. And also you need to understand the competition in that particular market and how you can fight that competition. And obviously any changes needed to make your product or services sellable, because it is quite possible that the kind of product your local market is using, probably your target market for export might not be using the same thing. So you will have to little bit modify as per the export market which you are targeting. Now, basics of imports. The import process is not difficult for small and medium sized enterprises, but it is little complicated if you don't have all the required information. So it's very important that we need to understand the documentation, the procedure. That is very important. And when you start importing, it's a good idea to clear about what you are trying to achieve. You might want to find a cheaper source of suppliers overseas, or to import products that are not yet available in your country. So you can check any goods will suit to your production process or satisfy customer demand. There are also extra issues to consider, such as whether imported goods meet our legal requirement, or do we have the required import license. So that is something we need to really consider it. Now, why companies go for export? Let's try to understand. Export helps increasing sales and profit, because when you are trying to export, you are selling additional. So your revenue will go up, and when your revenue will go up, obviously your profit will also increase. It also enhances credibility in the domestic market. If you are exporting to various countries, you can always tell to your players within domestic market and also to the export market that you are being accepted in the international market. So in a way, it enhances the credibility of that particular company which is exporting. It also protects fluctuation in sales due to cyclic changes. We all know that in every country, not only in India, but in every country, there is a seasonality factor. And whenever there is a high season, yes, you can sell the product without any issue in your local market. But when there are off season, then you can continue to produce same level, but you can export. So it is a kind of a win-win situation for the companies. It also enables better capacity utilization for production. Suppose you have a capacity, but you can't produce with full capacity because there is not much enough requirement of your product in the domestic market. So either you run your plant with a under capacity and then increase your cost, or you can run your plant with full capacity and try to export it so that your cost would be nominal. It also improves the cost competitiveness of the company due to increased sales and better capacity utilization, as I mentioned. Now, why companies go for imports or why people go for import? I think imports build competitiveness, no doubt about that. Because if you think that the raw material is not available in your country, but you need that, and you are finding that particular raw material in the overseas market, yes, you can import it. Sometimes specific brands are not available in your country, then you can go for imports. Also, sometimes goods are cheaper outside than in your own country. So it's a level playing field. If you are getting similar kind of raw material or even better, but with a less price, obviously nobody is stopping you to import it. So this is something about basically exports and import. Now let's understand what are the payment terms associated with exports and imports. Now, there are three standard ways of payment methods in the export-import trade in the international market. One is the clean payment, second is collection of bills, and third is the letter of credit with we all call LC. So we'll go one by one, and I will try to explain you what is clean payment, what is collection of bills, and what is letter of credit. So let's talk about clean payment. Now, clean payment method is basically all shipping documents, including title documents, are handled directly between the trading partner. So the role of bank is limited here to the clearing amount as required. Clean payment method offer a relatively cheaper and uncomplicated method of payment for both importers and exporter. But there is a catch here. You can only go for this particular type of payment once the exporter and importer they know each other very well. There is a trust level, and there are basically two types of clean payment. One is the advance payment. In advance payment method, the exporter is trusted to ship the goods after receiving payment from the importer. So here the risk is from the importer side because they have already paid the advance payment. And one is the open account. In open account method, the importer is trusted to pay the exporter after receipt the goods. So here, obviously, the little risk lies towards the exporter because once you will export, only after the export when the importer will be getting all the documents and then they will pay back money to them. So in this kind of, as I said, the payment system, the trust between the importer and exporter is extremely important. And as I mentioned, the main drawback of open account method is that exporter assume all the risk while the importer gets the advantage over the delay use of company's cash resources and is also not responsible for the risk associated with goods. The second method is basically what we call is the collection of bills, which is also typically called in international market is uniform rules for collection. It is being published by International Chamber of Commerce (ICC) under document number 522, and it is followed by more than 90% of the world banks. In this method of payment in the international trade, the exporter entrusts the handling of commercial and often financial documents to bank and gives the bank necessary instruction concerning the release of these documents to the importer. It is also considered to be one of the cost-effective methods of evidencing a transaction for buyer where documents are manipulated via the banking system. So it is little better than the previous one, and there are two methods of collection of bill. One is the document against payment, which is a direct payment. In this case, documents are released to importers only when the payment has been done. The other is document against the acceptance of DA. In this case, documents are released to the importer only against the acceptance of a draft. So this is also a good method in my opinion, but the most trusted method is letter of credit, because in this one bank like importer bank gives guarantee to the exporter bank that whenever the material would be dispatched and they will get the evidences of the dispatch material in form of invoice, packing list and bill of lading, the importer will pay money to their bank and the importer bank will pay money to the exporter bank. So it's a dealing between the bank to bank. Now, let's understand what is letter of credit. A letter of credit, also known as a documentary credit, is a written undertaking by the importer's bank, known as the issuing bank, on the behalf of its customer. The importer, which is applicant, promising to effect payment in favor of exporter, that is beneficiary, up to a stated sum of money within a prescribed time limit and against stipulated documents, which I said it: invoice, packing list, and especially bill of lading. These are the three minimum requirements. It could be other documents also, which I am going to talk about in my future lectures, basically. So this is one of the best form of payment system exists in the international market. The other very important aspect, friends, you need to understand is the export pricing. Now, pricing and cost are the two different things, and an exporter should not confuse between the two. While price is what an exporter offered to a customer on a particular product, and the cost is what an exporter pay for manufacturing the same product. So that's a basic difference between the price and the cost. Now, export pricing is the most important factor in the promoting export and facing international trade competition. It is important for the exporter to keep the prices down, keeping in mind all exports benefit and expenses. However, there is no fixed formula for successful export pricing and is different from exporter to exporter, different from market to market, different from companies' strategy, how they would like to be present in that particular market. The other very important aspect is that how you can determine the export prices. It can be determined by following factors like the range of the products offered, prompt deliveries and continuity in the supply, and obviously after sales service in product like machine tools, consumer durable, and extra. How the export pricing is being derived, that we will talk about little later in other units. There are three kinds of very famous pricing: FOB, CNF, and CIF. So I'm going to give you a brief on this in my additional lectures. Right now, we will going to talk about a little bit more on the export pricing. So the other point which export pricing is going to be dependent on the frequency of purchase. If somebody is buying more volume, obviously you can give a price discount to that person. It's also pre-assumed relationship between the quality and price. Specialty value goods and gift items and other things. So guys, export pricing is definitely on itself a very big subject, and in other units I'm going to explain you in detail how we should be going for export pricing and what are the strategies behind the pricing. In terms of the export costing, it is basically a cost accountant job. It consists of your fixed cost and variable cost comprising various elements, and it is advisable to prepare an export costing sheet for each and every product. Correct. So where you will have to add the fixed cost, variable cost, and then from your factory to the port, the logistics cost, the inland haulage, and all those kind of things you will have to consider it. So as regard quoting the prices to the overseas buyer, same are quoted in the following internationally accepted terms, which are commonly used as Incoterms. So we'll also go for what is Incoterms, and I will explain you in as I said it in coming units what is Incoterms is all about. Let's try to understand some more basics of exports and imports. Now, I mentioned in my previous discussion that for import you need to have import license. So let's understand what is actually import license. An import license is a document issued by a national government authorizing the importation of certain goods into its territory. Now, import licenses are considered to be a non-tariff barrier to trade when used as a way to discriminate against another country's good in order to protect the domestic industry from foreign competition. Sometimes you see when we have the prices in local market of onion or tomatoes, when they go up or pulses, suddenly government put a cap on imports. For the export, and then they lift basically the import, and people can import because there is a shortage. So it's not only our government, all the government time to time, based on the demand supply, they keep on imposing import license on a different items. Each license in the import license specify the volume of imports allowed, and the total volume allowed should be not exceeding the quota which has been mentioned. In India, import license is issued by DGFT, which is what we call as the Director General of Foreign Trade. and import license are sometimes valid for 24 months for capital goods and 18 months for a raw material of component, consumable, spares. But sometimes you will have to check it, the validity, because based on a specific product, it could be that they may change the validity of the import license also. The license can be sold to importing companies at a competitive price or simply a set fee. So, but sometimes it is argued that this allocation method provides incentive for political lobbying and bribery, all those kind of things. But I think, as I said it, that in business we have to be very, very honest, and we should be doing business for the benefit of the company, considering within the permissible limit of our country's rules and regulation. So let's talk about what are the categories of export. I think there are three categories basically very important. There are so many others, but at least here I would like to explain the three categories. One is the direct export, second is indirect export, and the third is deemed export. So friends, let's try to understand what is direct, indirect, and deemed export. Now, direct export is basically, it's a sale by an exporter directly to an importer located in another country without using another person or organization to make arrangements for them. Here, the exporter will be responsible for handling the sales process, logistics of shipment, foreign distribution, and for collecting payment. Indirect exports are typically related with the selling to an intermediary who in turn sell product either directly to the consumer or customer or to the importing wholesaler. So this is the easiest method of indirect exporting, is to sell an intermediary in your own country. So sometimes what happens is that small manufacturers, those who can't afford to travel outside, and they can't export, so they typically do the exports through the trading companies. So here the trading companies are basically intermediary. So you can sell it to them, and then since they are a bigger organization, they will find the buyer, and they will export on their own. So you will be out of all those headaches. The other one is the deemed export. Deemed export, I will explain you very simple term, that suppose dealer A, who is located in Rajasthan, sells good to dealer B, which is a export oriented unit somewhere in India. Now, that unit in turn sells to the customer C in Germany. Now here, supply by A to B is treated as deemed export. Supply by B to C is treated as direct export. Now, what is happening, that A is not directly exporting, but they are giving this supply to somebody else, which could be a export oriented unit, and they are using that particular product in form of raw material, and then they are doing the value addition, and finally they are exporting to the third country. But at the end of the day, the raw material sold by A is also is a part of the end product, which company B is exporting to the Germany, or to the customer C in Germany. So this is being seen as a deemed export. So direct export, indirect export, and deemed export. I've given you a little introduction about import and export, and I will be keep on coming and giving you some more on different units. In the meantime, basically go through these, and we'll come back to you. Thank you.